Welcome to the ETF Market Insights, your regular webinar series that focuses on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights with the goal of helping you become an informed investor. Make sure to visit www.youtube.com/ETF Market Insights to watch previous episodes, and remember to hit subscribe so you receive a notification when we post new content. Thank you for joining us today. Let's get started.
I'm Danielle Nuzzle with BMO Exchange Traded Funds. Thanks so much for joining us today on this Friday afternoon, everyone who is joining in live, and thanks to our YouTube viewers as well who are tuning into the channel and watching us on demand. It's so great to have everyone here with us. Today, we're diving into registered plans, RRSPs, TFSAs, and there's a few more we're going to highlight and talk through. But before we get started, today, we're not providing any investment advice and we're not providing any recommendations. Today's discussion is all around ETF education, investment education, and what we're really trying to do is empower investors to learn more about the markets, learn more about investing, so they have the tools they need to manage their own investments. Same story from our friends from InvestorLine who are joining us today. They're not providing any advice, nor are they providing any recommendations. They're also here to provide education and insights into investing and in the markets. So we have a great panel of speakers today. I'm so excited to have everyone here. So we have John Waters. John is a VP and Head of Tax Consulting at BMO Private Wealth. We have Trevor Philp. Trevor is also a VP in charge of group investment plans. And Chris Graham from BMO InvestorLine. Chris is a regional sales manager. So thanks everyone for joining us today. Now, Chris, I'm going to start with you. You have an interesting promotional offer you'd like to tell us about. Why don't you talk us through that?
Thank you, Danielle. Yes, with InvestorLine being a co-host with this presentation, we wanted to be able to provide opportunity for our viewers to get into some of these ETFs conversations that we're speaking about. So we're offering a self-directed promotional offer today with our InvestorLine site. So today, using the promotional code InvestSmart, our viewers will be able to open new accounts and get a discounted trading fee of $4.95 for all equity and ETF trades. Great opportunity to consolidate some assets with us and take advantage of that low offering. As well, we do have our Advice Direct services, which is our online advisable piece for a solution for customers that are looking for a little bit more guidance, a little bit more support. Today we're offering up to a $2,500 promotional offer to consolidate assets with our Advice Direct services. The Advice Direct services, again, do provide a little bit more hand-holding, more approach for customers that are looking for a little bit more advice inside of their services, provide some a little bit of financial planning solutions that are differentiate from our InvestorLine side. So using today, if you were to open up a new account until March 2nd and using the promotional code digital01, you'd be able to get up to that $2,500 offering. Next slide, please. The big thing, though, that we like to partner with our ETF partners out there is InvestorLine is happy to announce a couple of months ago that we have some commission-free ETF trades inside of our accounts. So we have up to 80 ETFs to trade on side of our portfolio to help customers that are looking to do some adjusting inside of their accounts, providing regular contributions to their accounts, and giving them time for rebalancing and diversification. If you go to the next slide, The commission-free strategy that we have on here is we are using 3 ETF providers out there, not only the BMO products, but iShares and Vanguard, to provide us a good selection of different ETF products for you to pick through. Some of the asset classes that we have in store include some equity components, not only just in Canada, the US, but some emerging markets and international equities inside of there, and using different types of styles and indexing methodologies such as strategic beta and cap weighted strategies to help you navigate through these markets. Also have a selection of fixed income ETFs that are split into a whole bunch of different subclasses. We have multi-assets to help diversify your portfolio range from pure equities to a more conservative approach, and a lot of thematrical different approaches that are kind of interest for a lot of our customers out there. So what we believe here is give you that solution to give you the most ETFs that are available out there, again, at a $0 commission rate. The last thing we'd like to just point out, because of the nature of the conversation that we're having today, is that you can find out a lot of solutions on your own in our self-directed sites under our investment learning center, where we have some videos to talk about tactical asset allocation inside of your portfolio, how to use beta inside of your portfolio, how to use ETFs inside of your portfolio. So always recommend for further education on our website when you're logged in under the investment learning center. Next slide. So again, thank you very much for letting me speak very quickly about our BMO Investor Line solutions. If you have any questions or concerns, would like to know a little bit more about what services that we can provide for your investments, either on the self-directed or our advice direct solution, please feel free to give me a call. My phone number and email address is there on the bottom of the page. And again, here are those promotional codes. It's on the self-directed side, Invest Smart, and then on our advice direct side, the Digital 9 code. Thank you very much, and I'll give it back to you, Danielle.
Thanks so much, Chris. Thanks for talking us through those promotions. So for all our viewers out there, if you missed an episode, or if there's something we're talking about today or in a past episode you'd like to re-watch, check us out on our YouTube channel. And while you're there, why don't you hit subscribe? We'd love to grow the channel and get our subscribers. It really just helps us build out our content and education. We had a fabulous January of topics. So if you'd like to go back and watch those are available to you. Our 1 minute ETF update. Well, our friends from National Bank release this report every month. We just got our January numbers in, and wow. One thing to note, 37 ETF launches in January. BMO ETFs, we were busy as well. We launched 11 of those 37. So a big number, just showcasing how more and more ETFs are coming to the market, giving investors those tools they need to build and tailor portfolios unique to them. Also interesting to note, equity ETFs really led the market flows in January. Of those $5 billion in ETF flows, equities certainly took in the lion's share. And the #1 ETF for market flows was ZSP, the BMO S&P 500 Index ETF. Interesting to see that there with a little bit of volatility in January. Maybe investors are looking at opportunities to get into the US equities using ETFs. So interesting to see that. Now, today we're talking about registered plans. What are available to you? What are the differences? What are the benefits? And on this channel, we love talking ETFs, so we really just want to highlight that ETFs can be used in all the registered plans we talk about today. They can be very efficient building blocks for investors to easily add to any of these accounts. They're cost-effective, liquid, diverse, all those great benefits. So you can use ETFs in all the accounts we're discussing today. Now, Trevor, I'm going to pull you into the conversation. So could you just give us the rundown of the 4 main registered plans that are offered to us in Canada, and kind of discuss, what are the key benefits to each?
Sure, absolutely, Danielle. I think the key point again with all of these plans is that they are all vehicles for you to invest within, right? So you don't buy an RSP, you invest within an RSP. And so really want to highlight that products can be held within these plans. I think the most popular one by most standards is an RSP. Most people have heard of an RSP, but what is that? It is a vehicle for saving for first and foremost retirement, but also the possibility of other uses for it, such as first-time home buyers or lifetime learners, so saving for education. So you can use it for a multitude of different things. You can hold various different investments within that platform. So there is an investment mix that can be held in there. Stocks, GICs, ETFs, mutual funds can all encompass those portfolios. There is an annual contribution limit with RSPs. So you're looking at $27,830 this year, or 18% of your earned income. So it's the greater of those two things would encompass the RSP limit for this year. But also want to note that you can have backed RSP contribution amounts. So you can check your notice of assessment that you receive from the federal government when you file your taxes, and that will provide you with your RSP backed contribution room, so you can take advantage of that and utilize that within the plan. When you make a contribution to an RSP, you will receive a tax deduction. So you'll receive a contribution receipt that you use to deduct that income off your income tax return. So it is a way of providing not only savings for your retirement, but also a way for you to get some money back on your income tax. Maybe flipping over, Danielle, to the tax-free savings account. Tax-free savings account, relatively new thing. Started back in 2009, and what that is an amount that you can contribute in after-tax dollars. So unlike the RSP, you are not going to receive a tax receipt for your contributions to a TFSA, but likewise, you will not pay taxes when you withdraw money from the plan. So this is a way to save in after-tax dollars. Much like an RSP, there is lots of assets that you can hold within your TFSA account. GICs, stocks, mutual funds, ETFs. So you can utilize that to save in many different ways. $6,000 is your TFSA contribution room for this year. But much like an RSP, that if you have not contributed to a TFSA in the past, you have possible contribution rooms of up to $81,500. So good way to save if you've maximized your RSP, or you're looking at saving for something other than retirement. A TFSA can be a great vehicle for that. Flipping over maybe to the RSP, Danielle, our RESP here. This is savings for education. So if you have children, this is the one you really want to pay attention to. Looking at this, it provides you with an amount of 20% in grants that can be paid for money contributed to this account. So if you put money in here, you will receive a contribution from the federal government up to $500 per year. There are also some incentives for individuals with lower incomes, the Canadian Learning Bond that can be put into the account, and those can be taken advantage of with no contribution in there. Much like a TFSA or an RSP, we have lots of different vehicles that or lots of different products that we can hold within an RESP. So you can hold, ETFs and stocks and bonds and mutual funds within the RESP plan. And there are ways, if your children do not end up going to school, where you can roll this into your RRSP. So really, I think if you do have children and you're looking for a way to put some money aside, I think an RESP is a great option. You obviously have that money that comes in from the federal government, and you can also, if you have more than one children, that you can save using what we call a family plan within an RESP, which will allow them to share that money. So if one maybe is going to use a little bit more than the other, that's a great way to save for their future. The last plan to talk about is the Registered Disability Savings Plan, and this is again a relatively new plan, but I think is really important to highlight, especially for individuals who are living with a disability or have family members who are living with a disability. This is a way to save for their financial future. Much like the RESP, there are federal grants that are available based on the contribution amount that you make to the plan. And the grants are significant, up to $70,000 in grants that are available for this. So I think if you do know somebody who is in this situation, just bringing an RDSP to their attention. Again, like any of these plans, lots of different products that can be held in here, but some pretty significant free federal money that is available for the RDSP.
Thanks so much, Trevor, for talking us through those 4 accounts that Canadians can take advantage of. So, John, I'm going to turn to you. So, Trevor did a really good job of breaking down the differences between RRSPs and TFSAs, and he gave us really good explanation on how they can be used. But what we're getting from investors a lot, or what we hear from investors is, which account is right for me? What is the framework investors should consider when thinking about these accounts and using them and deciding which one to contribute to first?
Sure, Danielle. Maybe just a bit more background to expand on a couple of the points that Trevor made. As mentioned on the chart there, you can see the contribution room for a TFSA. It accrues annually, and right now it's a $6,000 amount that gets added, and you basically just have to be over the age of 18, a Canadian resident. And as Trevor mentioned, there's 81,500 available if you've never contributed. On the other hand, an RSP requires that you have something called earned income, which includes things like employment income or self-employment income or net rental income as an example. And a percentage of that up to a limit, which is 27,830 in 2021, would be eligible for RSP contribution room. So for it's always sort of looking at the prior year's earned income to determine the current year's available RSP room. Contributions, as Trevor had mentioned, to tax-free savings account are not deductible for tax purposes. On the other hand, for RSP contributions, they are deductible. And then, of course, the flip side of that is that if you withdraw an amount from your TFSA, it is not taxable to you. And it also allows you to make a future contribution equal to the value of what you would have withdrawn in a subsequent year. On the other hand, because you got a deduction for the contribution to your RSP going in, the amounts that you take out of your RSP are taxable to you. Now there is a few exceptions. One notable exception would be the first-time home buyers plan, which allows you to withdraw up to $35,000 from your RSP to help finance the cost or construction of a new home. And you would have to repay that back to your RSP over a period of 15 years. But it's important to note that any amount that you withdraw from your RSP cannot be added back to the contribution room in the same manner that it could for a TFSA. So it's never a good idea if you think you're going to need the cash later in the year to make your RSP contribution, then take it out because you'll lose that contribution room. And then the final point here, another main difference between the two accounts is that the TFSA kicks in at age 18, but there's no lifetime, there's no age limit to it. So you can keep that going for the rest of your life. To keep that flexibility, whereas an RSP at the year that you turn age 71, by the end of that year, you would have to collapse that RSP, and typically what one would do is transfer that to a registered retirement income fund, or perhaps take an annuity, or perhaps even cash it all out, although that's not generally recommended. So the main differences in terms of what is right for you would be the age requirement or limitation for RSPs. Is one factor, and then the ability to get a deduction for an RSP versus a TFSA is another factor. So generally, we would look at the tax rate, the marginal tax rate that an individual is subject to at the time they're considering a contribution, and also at the time they're looking to withdraw those funds, for example, at retirement. So to compare the two, generally an RSP would be more beneficial if you're if you're in a higher tax bracket at the time that you contribute and get that deduction versus the time that you withdraw and are taxed on that withdrawal. And if the reverse is true, if you're in a low tax bracket today, but are likely in a higher tax bracket down the road when you expect to make a withdrawal from the account, then a TFSA would be preferable because of because the withdrawals are not taxable. So for someone that's not in a high tax bracket, they're not going to get a benefit to an RSP contribution. So TFSA is often preferred in those scenarios. But obviously, you need to look at this individually, case by case. In addition to the tax bracket, what is the purpose of your savings? Is it for short term to buy a car in a year or two, or is it for retirement? What does your income look like in retirement, your other sources and company pensions and things like that? But I would also say, ideally, in a perfect world, if you had sufficient funds, what you would do is contribute to your RSP, get that nice tax deduction, and use that tax refund to contribute to your TFSA.
Thanks, John. So many good points and considerations there. Thank you very much for that. I'm going to stick with you for this slide. So we are heading into, we call this RRSP season right now. Can you talk us through the key dates and the key numbers in regards to this?
Sure, Danielle. The main key date would be March 1st of 2022. And that is the deadline to make a contribution to your RSP to get a deduction on your 2021 tax return. So it's generally 60 days after the end of the year. And as you can see here, the limitation, the most that you can contribute would be $27,830, or it's the lesser of that amount, or 18% of your prior year 2020 earned income, which, as I mentioned, employment, self-employment, net rental income, and the like. And of course, less any applicable pension adjustments. So if you're a member of a registered pension plan set up by your employer, then that would typically reduce your ability to contribute to this RSP. And also added to that balance would, of course, be any unused contribution room from a prior year. Now, I'd also point out that as of January 1st of 2022, your RSP contribution room for 2022 opens up. And of course, that's based on your 2021 earned income. So we tend to be working towards the deadline. We tend to be thinking now about making our 2021 contribution to RSP, but it is also possible to make a contribution for 2022 as now and as early as January 1 of the year to get that extra year of deferral. Now, with the other accounts that Trevor talked about, there aren't any specific deadlines, but it is something that we also like to keep on top of year to year. So in the case of a TFSA, the amount that we can contribute for 2022 is $6,000. And that is indexed year by year, and it has bumped up from 5,000 originally, and it's possible that could go higher in the next coming years, but currently 6,000. But of course, keep in mind that if you haven't been making contributions in prior years, that you likely have some room that is carried forward and can be used now or in the future. And then the RESP, there is no maximum, or for that matter, minimum annual contribution limit. However, there is a maximum lifetime contribution limit of $50,000 per beneficiary. But that could be made over a 31-year period of the RESP once it's that's the maximum amount, or 35 if you've got a disabled child. Now, I would also mention that, as Trevor alluded to, that there are some grants that could be paid for RESP contributions. Those are at 20% up to a maximum of 500. So 2,500 annual contribution would get you that maximum savings grant. Which over the lifetime is a maximum of $7,200 per beneficiary. So typically we like to make contributions to the RESP annually, if for nothing else, to make sure that we're up to date with getting those grants each year to get that 20% for the government to kick in.
Great, thanks, John. And for anyone thinking about making an RRSP contribution for 2021, March 1st, 2022, mark it on your calendars. That is the deadline. So, John, what other considerations should investors be aware of or be thinking about when they're using these accounts?
Yeah, there's a couple of other things to think about. As tax practitioners, we're often talking about the benefits of a spousal RSP. So this is a scenario when you might have a couple with disproportionate incomes. So you would have a higher income spouse who presumably would be generating, say, employment or self-employment income and generating that earned income to have that RSP contribution room. So they could make a contribution based on their own RSP deduction limit to their spouse's RSP. And the idea here is that the contributor at the top or the high rate would be getting that deduction and the tax savings at a higher rate. And then down the road, ideally at retirement, their spouse who has fewer income sources now and in retirement would take the amounts out of that spousal RSP and be taxed in their hands, presumably at a lower rate. So you get the benefit of not only the tax deferred growth within the RSP, but income splitting by being able to switch from a high income to a low income spouse. Now, if you do set up one of these plans, it's important to remember that this is a long-term play, and there are some rules that would prevent this benefit if it is just over the couple of years after contribution. In particular, if you make a contribution to a spousal RSP in 2022, your spouse would have to wait until 2025 before they could make a withdrawal, assuming there were no other contributions, because of this look-back rule. And if they did withdraw within that 3-year time period, that withdrawal would be taxed in the hands of the higher income spouse, the contributor. So sort of take away that advantage. So that's one thing to keep in mind with the spousal RSP, that it is a long-term play. The other thing, a common scenario that we often talk to clients about is over-contribution penalties. So as mentioned, we've talked about the earned income generating those RSP deduction limits, but it's often quite common for people to put in more in their RSP, not to be tracking these limits, or making contributions through a work plan and then making them personally as well. So if you do find yourself in that scenario, fortunately you do have a buffer of $2,000 for an over contribution to allow you as I say, a bit of a buffer. But if you exceed that $2,000 amount, then there would be a penalty tax of 1% of the excess over that $2,000 for each month that over contribution remains in your RSP. Now, if you're generating earned income and generating that RSP room annually, then, and particularly if it's late in the year and you find this out, you might just wait until the next year, because as I mentioned, that contribution room will open up as of January 1st, and that'll sort of take away the problem as long as you don't continue to make it worse by making further contributions. But for people that it's maybe earlier in the year or it's quite a significant balance, then you've generally got two methods of solving this issue with the over-contribution. First one, I sort of call it the rip the Band-Aid off approach, where you just take that over contribution over that 2,000 amount and you withdraw that. The downside is you'd have some withholding tax on that amount withdrawn, but you could get that back when you file your tax return for the year of the withdrawal, but there's a time lag there obviously before you file and it gets assessed. The other alternative is that you file some forms with CRA to be preemptive and get them to certify that there would be no withholding tax because you never got the deduction going in. So this process takes a little bit longer, but has the advantage of not being out of pocket and having to wait for that refund to come. So a couple of options there, and a lot of it depends on the timing and the amounts. The last thing that I would mention here is another topic that comes up quite a bit, is looking at what you're investing in your RSPs. And if you're looking to get some US exposure, particularly on, obviously ETFs are a great solution there for a number of reasons. But if you own, if you're looking to own securities directly, then we need to be aware of withholding tax. So typically in a non-registered account, if you own a US security and it pays a dividend, there's typically a withholding tax rate at 15% to a Canadian investor. Now, in a non-registered account, you'd have the ability to claim that as a foreign tax credit on your tax return to reduce your Canadian tax otherwise payable. But generally, if this was in an RSP or another registered account, you wouldn't be paying tax in that account and don't have the ability to claim a foreign tax credit. But fortunately, there is a relieving provision in the Canada-US treaty that exempts US dividends from securities, US securities held directly from any withholding on those dividend payments, so that you don't have this issue and you can receive those dividends free of tax. Now, I would point out, however, that this exemption does not extend to either the tax-free savings account or the registered educational savings plan, the RESP that Trevor talked about before, because these are not considered retirement accounts under the tax legislation. So in those scenarios, it's really a cost of owning that particular investment in those accounts, because the withholding tax would apply and no ability to recover because you're not paying tax within these accounts. So it's something to consider certainly in your asset allocation amongst all your different accounts when you're selecting your investment choices.
Thanks. There's a lot of really valuable information you just walked us through. And a reminder, if anyone wants to hear that again, this will be posted on our YouTube channel. If there was a point John made you want to get back to later on, this will be available to you at any time to listen to again. John, can you give us some tips towards using RRSPs and TFSAs and maybe setting up a good plan to best use these accounts effectively?
Sure, Danielle. Just a couple of other points that we commonly discuss when we're looking at TFSAs and RRSPs. First, as I mentioned, make sure that you are on track of your contribution rule for your RRSP. That's something, and for TFSA for that matter, something that would typically be reported on your notice of assessment. As it relates to RRSPs, keep in mind that after the age of 65, if you've converted your RRSP to a RIF, that you have the ability to access the pension income splitting rules, which is beneficial, like the spousal RRSP, when you've got disproportionate income amongst you and your partner. For people that don't have available cash to contribute to either their RRSP or TFSA, it is possible, if you have a non-registered investment account, to transfer those securities in kind to either your RRSP or TFSA. But a couple of things to keep in mind, of course, is the contribution room, and compare that to the fair market value of those investments. But also, if the investment is in an accrued gain position, that you would trigger that gain when you did the transfer, because it's the fair market value versus your cost that would result in immediate capital gains taxation. But on the flip side, if you are in a loss position with that security, any transfer to those registered accounts would actually be denied for tax purposes and effectively lost. So it's never a good idea to transfer in securities that are in accrued loss position. Now, for older investors, the TFSA, as I mentioned before, gives you a tax efficient means of investing with the tax-free growth after the age of 71 when you have to collapse your RRSP. So for, say, seniors or those with a RIF, if you're subject to those RIF minimums and have some excess cash that you don't need but have to take out of that RIF, good idea is to put that back into your TFSA and continue with that tax deferred, or in this case, tax-free growth. And for those that are over the age of 71, but are perhaps married or in a common law relationship with a partner that is under the age of 71, it is possible to contribute to a spousal RRSP for that spouse or partner under the age of 71, provided you're still earning, have that earned income and are generating RRSP room. You can contribute to a spousal RRSP up until the year that your spouse or common law partner, the end of that year in which they turn age 71. And then similarly, once you reach age 71 and have to mature your RRSP, say, into a RIF, you could base your RIF minimum payments on that younger spouse's age. So those, because they're a lower age, that would be a lower amount for a RIF minimum that you would have to take out each year to give you more deferral within the RIF and greater flexibility.
Great, thanks for that, John. I want to save a little bit of time for questions. I think we have time to take one. So here's one on a TFSA. How is the total TFSA contribution room affected if I'm making periodic withdrawals and then some of the capital gains is therefore crystallized? And what I think this investor is getting at is it the book value or the fair market value that you're looking at, John, when you're re-adding back into that TFSA?
Yeah, great question, Danielle. It is the fair market value that you look at, not the book value. So if I took a simple example and say year one that I'm contributing to an RRSP, if I put in $6,000 and that grows over time and it's now worth $10,000, we've got some good growth on that, and I decide to take that out. As I mentioned before, you've got additional contribution room generated in the following year that would be equal to that $10,000 fair market value. So it's not the book value of what you originally put in, it's the $10,000 that you've taken out, that fair market value of that security at that point, or that cash, that gets added to your TFSA contribution room going forward.
Thanks so much. I think that's a really good point to make. We get this question a lot. Thanks, John. And thanks to Trevor and Chris as well for joining us. Next Friday, we're taking it off. It's a long weekend here, so we won't be around next Friday. But if you'd like to watch more content, check out our YouTube channel. But we will be back Friday, February the 25th. And we're talking about low volatility strategies. We're seeing a lot of volatility pick up in 2022. So we're going to talk about mitigating that using ETFs. We'll see you next time.
Thank you for watching the Market Insights webinar series. To stream any previous episode of the Market Insights webinar series, please visit www.youtube.com/ETF Market Insights. Remember to hit subscribe so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at www.etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or a recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.